Hello everyone, welcome back. So, this is the last topic, I must say. And till now, we had discussed regarding what is a monetary policy, fiscal policy, RBI, money supply, inflation. Now, in the initial of the class, I had discussed that interest rates come into play. But what interest rates are there and how they are regulated? This is something we are going to discuss in this video. Now, first of all, I would like to ask a question from all of you. Does government require funds? The answer would be yes, right? What are the ways government can raise funds and government can get more money? Number one could be taxation, fiscal policy, right? Number two, they can print their currency because printing currency is still in the hands of the government. Number three, as I told you in the story of investment banking, that yes, government can also issue bonds for a short period of time. Now, bonds are of multiple types, which we are going to discuss in the chapter of bonds. But bond is a journal, if I say in a very simple terms, bond is a piece of paper, it's a promissory note, where government gives you promise that please give us money, and in return, after this specific period of time, we will be returning your money back plus some interest. This is government bond. And these government bonds in money market is generally less than 1 year. As I told you in the initial of the class, in money market there are no birthdays, right? So there are no birthdays, it means it is less than 1 year. So government raises money from various sources issuing government security. Government security is the name given to government. There are bonds which are more than 1 year as well that we are going to discuss in the chapter of debt market. But today in money market, we are going to discuss just one type of bonds. These are government securities. A promissory note where it will be written Government of India, please give no the money given us to this. We will be returning your money after this much time with this much interest and the stamp of government. So this is a government bond. And who issues these government bond? These are issued by RBI and these are issued by the central bank of all the countries. So guys, what best could ever happen if government itself is issuing a bond and no one can distrust or no one can have lack of trust on the government is something at the utmost level. No, government can't cheat, right? So this is the faith people has on these government securities. Not only people, entire world has the faith on the government securities. Government securities act as assets. Government securities acts as, you know, all the countries they invest in other countries' government securities. Just this level of trust is there in the government securities actually. So let me repeat myself. Government security is a bond issued by the government of all the countries to raise money for a shorter period of time, right? Go to fulfill their short-term money requirement. So this is called as government security. So all the countries central bank issue government securities. It could be USA, Canada, Sri Lanka, India, everybody issues. Now, the question is that I told you it is a promissory note. The promises are meant to be broken, right? Can government default on government securities? Though it is very rare event, but yes, it may happen. Because this happened in Sri Lanka, this happened this now Pakistan is also defaulting on some government securities. But just imagine, now I'm going to give you a very important story. And this story is called as debt crisis of the. What is debt crisis? Debt crisis is something related to bonds. Debt crisis is something related to issuing of government securities. Now let's see the world map. Now this is United States of America, the most trustable country in terms of finance. Entire international business takes place in dollar. Crude oil transaction takes place in dollars. So Federal Bank of United States of America also issues government securities. An entire world invests in these government securities. India, Pakistan, South Africa, South American countries, African countries. All these countries they invest in these government securities. What I want to say that if USA needs money, so how USA fulfill its the money requirement? By issuing government securities. And to whom these government securities are issued? To the entire world. For the domestic market as well and for international market as well. Domestic means domestic investors as well, and international countries as well. So our central bank RBI also invest in these bonds. Sri Lankan bank, Pakistani bank, Australian bank, all these invest in these bonds, government securities, especially American government securities. But my question is, guys, what if America defaults? What if America is unable to return the money? Means, for example, America raised money for 6 months from the entire world in government securities, right? But what if they are unable to pay it after 6 months? Maybe they pay it after 8 months or maybe after 1 year. There is a default. This crisis can lead to a big cascading disaster throughout the world. See, we all countries, we are dependent on each other so much that we all are invested somewhere else. Similarly, other countries invest in India as well. These countries they invest in India, African countries invest in Indian government security. So we are so much dependent on each other, guys. So that is why it can lead to a world crisis as well, right? And in the debt market, we are going to discuss, how uh, mortgage-backed securities work and how it led to 2008 crisis. That was again issuing of bonds, right, and raising money, and it was a cascading effect that led to a failure of the entire economy, entire banking system actually, and all the investment tools. So we have to be watchful for this. I hope you got the point. So thus government securities play a huge role, a big role, especially in monetary policy and especially in uh, money market. Now, one more thing I would like to tell you over here. It means government securities we are studying under the chapter of you know monetary policy under the chapter of money market. It means these government securities are also used as a tool to raise money, to suck money from the economy, to regulate the money supply. Let me give you a very practical example. Your father asks, your father gives you pocket money, you and your siblings, right? And you start enjoying the money. You start, misusing the money. But your father realizes that you're misusing the money. So what he did this time, he writes a paper to you, a promise to you, a promissory note that beta, please give your money to me, your 100 rupee. I will return 150 rupee after 3 months. And he gives this paper to you. This paper is a bond, a promissory note, or you can say in the easy words, a government security. And in return, what I did, being a father, I took your money and I give this piece of paper to you. So don't you think that government securities are used to suck the money from the economy, from the family? So it means, yes, I can suck the money supply from the economy. So this is how the entire government securities work in the exchange of the government. This is how the entire money supply works. Money supply is regulated with the exchange of government securities. Just remember this sentence. This is a very important sentence. Money supply in any economy works against the government securities, against the exchange of government securities. This is statement number one, right? Statement number two is money supply in any economy is controlled and regulated by the alteration of the interest rates. These two things play a big role, guys. I hope it is clear to everybody, right? So we got to know that yes, government also needs money. We got to know governments can also default, and we got to know that using the government securities and using the interest rates, government can regulate the money supply in the economy. I hope this is clear to everybody. All right. So this is the government security. Government security is a name, a technical name given to the bonds, basically. And against the exchange of these bonds, the money supply is regulated. So government security is treated as a very important asset, guys, a very trustworthy asset because it is issued by the central bank of any country. Just imagine, it is the highest body, epitome, right? There is nothing above than the government of central government. There is nothing above than the central bank. Small, people, small industries may issue bonds. But these are small players. There is a hierarchy, but there is nothing above than RBI and the central government. So if they are issuing something, it is regarded as highly trustworthy. It is regarded as an asset in the financial system, right? So even banks use these government securities as an asset in CRR and SLRs, and sometimes in repos also they are treated as exchange tools. So that is why government securities play a big role in terms of controlling the money supply and in terms of trust. I hope this is clear. And since money market, the lifespan of money market is less than 1 year, so it is just equivalent to liquid cash. But I want to say it is so liquid because it is less than 1 year. It is considered as equivalent to cash. It is considered as a very important asset. Cash is also an asset. Similarly, government securities are also considered as an asset only. All right. So this is how the entire system is regulated using the using the government securities. So these are few types of bonds which I had, arranged snippets I had arranged from the internet. This is a corporate bond. Now we are going to discuss what is a bond, how it works. So in a bond, actually, what exactly is written? Name of the company, money raised, money promised. They are going to return after some specific period of time. A time is also mentioned, and a stamp would be there. This is a corporate bond issued by the companies. We are going to discuss all these more types of bonds in the debt market. So this is a Russian government. See, just imagine. So it is a legal paper, guys. Russian government, a stamp, and all these things. This is a government security. Similarly to some, there are treasury bills as well. See, state of Georgia, they are raising this much amount of money, and they are going to return 12% interest. So this is how it is mentioned. Money they being raised, what is the interest you are going to pay, and how much time the money is getting blocked. There is a lock-in period basically. All right. Now, first of all, let's see how a banking system works. How a bank works. This is a very simple thing, and all you are aware that banks are not there to do charities. Yes, in India, PSU banks are there to serve the people. PSU banks are there to do the penetration in the Indian economy. But generally, if I tell you, banking is a corporate entity, guys, which is there to earn profits. And how banking system earns profit? This is a very normal thing, and you all must be aware. Depositors deposits their money into a bank, right? For example, over here we are depositing 10 rupees. So a depositor is giving 10 rupee to a bank, right? Now this bank will give the same 10 rupee which was deposited by the depositor to a borrower, the person who takes loan. So this 10 rupee goes to a loan as a loan, basically. It's just an example, huh? Just treat it as an example, nothing technical yet. Because we are going to discuss CRR, SLR. But I'm going to give you a scenario after this. 10 rupee of a depositor is deposited in a bank, and this bank gives this 10 rupee to a borrower. So when depositor is giving his money to bank, the bank had promised this depositor that he will return 11 rupee, is 1 rupee extra as an interest. So this guy will make 11 rupee from his 10 rupee. He's also happy, right? Now how this bank will manage this extra 1 rupee? Means it must come from somewhere, right? This bank has given the loan to a borrower, and this borrower had promised the bank that he will be returning 14 rupees in return against the 10 rupees. So bank is in the profit of 4 rupee yet, right? So bank will get 4 rupee extra against this loan. And out of this 4 rupee, bank will pay 1 rupee to depositor, means 11 rupee back. So bank will be at the net profit of 3 rupee. This is how banking system, entire banks of the country makes profit. Apart from this, banks give services as well. They charge money for that and many other things. But this is a core thing, how the banking system works. But guys, don't you think there is a flaw in the system? The flaw is that the borrower's money was given to a loan, was given as a loan, right? Now, if this borrower doesn't repay the loan, just imagine the situation. So this loan, this 10 rupee was given to this borrower. But if this borrower suddenly goes bankrupt, suddenly, have some, there's a sudden demise in the family or something, something wrong happens. The depositor's money will get stuck over here. Bank will be unable to pay back his money. Just imagine this situation. Your money, you deposit in the bank, and when you go for the withdrawal of that money, bank refuses to pay back. So it's a very complicated situation. Your money is getting stuck, and this can happen. Yes. Now it's a very critical situation, and this situation had happened in 2008 crisis, where the entire banking system it collapsed, right? Because it was a combination of mortgage-backed securities, it was a combination of a debt market, real estate market, of blunders taking place, and it was the crisis led, because of CRR, SLR, dilutions basically. So the entire depositors' money got stuck in the bank. And I want to ask you, it's a homework for all of you, that how much money is insured in the bank. Means, for example, Mr. Lakshman had deposited 25 lakh rupee in the bank. What would happen to the Lakshman's money if the bank, bank goes bankrupt, or bank faces a failure, financial failure, or someone steals the money, or something happens, something wrong happens? So will Mr. Lakshman get 25 lakh rupee back, or is there some minimum amount insured and rest of the money will be lost? It's a homework for you. So there is a risk in the banks as well. We in investment banking, we always say the safest thing to keep your money is in a bank, but it's really not safe. If I tell you, the recent and the best example is Yes Bank. Yes, in Yes Bank, what exactly happened? The same situation happened in the Yes Bank. Depositors were depositing money in the Yes Bank, and the managing directors of the Yes Bank and the board of director team, they started taking risks, and they started giving some risky loans to some risky borrowers, and these borrowers converted into NPAs and their money got stuck. And guys, it is really heartbreaking that even till today the depositors had not received their money back. The case is in the Supreme Court, but the money is so huge that the bank is unable to pay back. Secondly, many of the people's family were in hospitals. Many of the parents, they were having some medical checkups, old parenting. Some of the families, the children they were about to go to college, but the money got stuck. So it's a advice, being in investment banking, always invest your money in different baskets. Similarly, always keep your money in different banks, at least two or three banks, so that if something happens in one bank, your money is at least secure in the second or third. And don't only invest entire money in saving account. Try to park money at different investment tools that we are going to discuss. Means you can invest some in gold, some in jewelry, some in bullion, that is some physical assets, some in real estate, some in mutual funds, some in equity, some in bonds, some tools of FD, PPF, some insurance schemes as well, some pension schemes as well. Try to diversify the things. More diversified it is, better it will be for you, right? Now, same situation, guys. If I tell you the recent current affair of 2 or 3 days back, the same situation is happening in India. RBI had given, we had just discussed that RBI have this qualitative tool. So RBI had given this announcement. RBI had made this announcement that banks depositors are not depositing money in the banks. This is the latest news, 2 or 3 days back. People are parking their money at different places now, mutual funds, equity, bonds. So people have stopped depositing money, or the money of the depositors have really gone down basically. So guys, it is an equilibrium. Just try to see this thing. If this thing decreases, absolutely it will put impact in the loans, and if the loan decreases, it will put impact in the depositors money. So it is quite relatable to each other. So now what is happening, since the banks are just giving 2 to 2.5% interest on your banking saving account, so and it's better, and people are getting more financially aware. People like you are doing investment banking courses. who are investing their money instead of bank deposit savings accounts. They are investing their money in equity, mutual fund, and other investment tools. So if bank will stop receiving this, or bank will start, if banks are receiving less depositors money, so bank will be unable to give more loans. So banking system has a burden of such kind of things are happening. So RBI had told that they are unable to give loans. So just imagine, guys, this is a equilibrium. You have to maintain a very thin balance between that. If any one of the things are, the balance is shaken actually, so both the things will collapse, and it will be a big burden on the entire economy, because banking system is the only system who keeps economy of the country and of the world, baseline. You can imagine in COVID crisis, it was the doctors and the bankers who were allowed to do the job. Rest everyone was quarantined at their homes. I hope you got the point. What is the importance of the banks? Now, guys, there are few terms. We need to understand these terms conceptually, and then I will try to relate these terms in terms of monetary policy, how it works in the monetary policy. All right. Now, first, and these terms are very important throughout. And we, as investment bankers, as commercial bankers, as economists, we need to understand these terms. These are the base and the fundamentals. First of all, let's start with the repo. The full form of repo generally is repurchase. But repurchase of what? What we are repurchasing. So I told you these all terms you're studying under monetary policy, under money market. So it has to be something linked with either government security or interest rates. Two things. I told you money supply can be controlled, can be regulated against the interest rates or government securities. Right. So coming to the repo rate. Repurchase. I told you RBI issues government securities. It is just like IPOs. As IPOs are issued, similarly government securities are issued at specific dates after specific announcements. Right. So when RBI issues government securities, right? So it's an initial launch. So guys, government security is just like when IPO is launched, initial public offering. Similarly, over here as well, there is announcement is made, and these government securities are taken as assets as well. Bank do intra-bank transactions, interbank transactions, and with public transactions, with corporate transactions. Let me tell you, very simple way. If PNB Bank wants to take loan from SBI, so it can keep this government security as a collateral. I told you it is considered as an asset. If this same SBI wants to take loan from Mr. Adani or from Reliance company, again it can take loan against this, right? If SBI or PNB Bank wants to take loan from RBI, again they can keep this government security as a collateral. So government securities are considered as an asset. I am repeating myself again. So everything is happening in the exchange of these government securities. Even it is a loan or a very short-term loan, mean overnight loan, 1 day loan, 3 day loan, 1 week, 1 month, 3 months, 1 year loan. All short-term and long-term loans are exchanged against these government securities only. So that is why government security play a very important role. Now coming to repurchase agreement. Repurchase agreement means it's the RBI who had issued the bonds, government securities, right? So when RBI repurchases the bond back, right? So RBI over here, see the diagram over here, guys. RBI is taking the government security back and giving the money to the bank. So over here, the money supply is being increased. I hope you got the point. Point number one. So guys, I'm giving you two definitions over here. So see, we need to understand the concept. Once the concept is understood, you can take it any way around. So one definition would be around the government securities. Second definition would be around the interest rate. So I told you money supply can be controlled by two things. Similarly, I'm going to give you an explanation which will cover up both the concepts. Conceptually, it's very important. You don't have to cram the things. You have to understand it conceptually. This is a one way we can see this repo rate. There is second way as well. This time, banks are borrowing funds by giving government security as a collateral. I hope you got the point. Now, this is the second definition, you can say. The banks are giving government security as a collateral to either any bank or RBI, and in return, banks are taking loans, right? So again, I can say it with respect to RBI, with respect to a bank, with respect to A, with respect to B, or with respect to government security and with respect to interest rate. It is the concept that needs to be understood. So whatsoever is happening either with the motivation of increased interest rate or decreased interest rate, or with the exchange of this government security. So if you always want to remember this thing, repo means repurchase. So something is some entity is repurchasing something, and what is being repurchased? It is the government security. And if I am taking the government security back, so I will be giving something. So I will be giving the money to the another party, because it is always with the money is always exchanged with a promissory note, that is government security. So it means I am taking the paper, the promissory note with myself and giving money to the other party. It is increasing the cash flow. It is increasing the money supply. So I hope this is clear. Repurchase of the government securities. And the same definition can be said in this way: when the banks borrow funds from RBI or from any another entity in exchange of, again, government security as a collateral, right? So this is how the entire system works in the repo rate. I hope this is clear to everyone. Now coming to reverse repo. Now reverse repo is absolutely opposite to this. Repo again meaning the same thing, repurchase agreement, but this is a reverse, so it will be opposite, right? So what is happening over here, guys? We need to understand this thing again, guys, conceptually. Now there are two statements. I want you to answer the statement which statement is true. Anyhow, you can see on the screen, you will be able to easily recognize which is true and which is false. Statement number one: rate at which RBI borrows funds from the bank. Rate at which banks deposits money to RBI. So absolutely, statement number one is false, because RBI never borrows money. RBI is grandfather. RBI is the bank of the bankers. So it is our wall. So it will never need money from the small banks, right? So this statement is false. It is a rate at which banks deposits their money to RBI. Means what is happening over here? Banks are giving money to RBI, again in exchange of government security. But this time, RBI is sucking the money from the entire system. So the rate at which banks keep their excess funds with RBI. And why would a bank keep their money with RBI? So that they get more interest, guys, right? So it can be seen as they're parking some extra money to RBI so that they can get some extra income. All right, guys, let me tell you one thing. And stock market also works on the same principle. Basically, we are retail investors, right? We invest 10,000, 20, 30,000, 50,000 rupee, and if we make even 100% amount of money in 10,000, we will be making only 20,000 in return, right? Just imagine you have invested 100 crores, 200 crores, and you are getting 100% return. The returns would be huge. What I want to say, this you might have heard, the RBI changed repo rate point by point 2 point basic base points, by point 0.5 base point, or point 1 base point. It seems to be too low, but guys, just imagine, it is related to economies of scale. When things become huge, if you are in if banks have money of entire all the citizens of the country, thousands of crores, even 0.1% return on 1,000 crores will be huge, guys. It will be huge. The best example I could give you, who will make more money? I invest 10,000 rupee. If I even get 100% return, it will be just in thousands, 10,000 extra. But if a person who had invested 500 crore rupee, even 10% return, 20% return, 100% will be huge, unimaginable huge. But if I'm investing that much amount of money, my returns will also be very high. This is what happens in economies of scale. It means when I am expanding my business throughout the country, this is what is being taught in the Shark Tank India. If I am having a restaurant in a small city, how many customers can I tackle? I can tackle 100, 200 customers in a day or 500 in a day. Just imagine if I increase my customer base to thousands and crores of people one day, even I make 1 rupee from one customer, I will be making huge returns. This is what, Patanjali, Swami Ramdev, he earned a lot of money because he penetrated to the villages. So more consumers, but less margins, he made huge. So this concept is very much prevalent in the stock market as well. To get better returns, you need to invest more as well. So that is why it is always advisable that if you want better returns in the stock market, try to earn more money first, increase your income, and then try to invest. All right. Now, instead of investing small amount of money and making small returns and being feeling happy with that, I would suggest you to earn more money and then invest. It will be better. And when you are young, try to invest more on the skills, on the learning part. Right. Now coming to cash reserve ratio. This cash reserve ratio is something related to this story, guys. How banking system works. I told you. Means bank depositors give money to the bank and bank give the loan. What if the loans are failed? If the loan turns into an NPA? So banks will be unable to recover the loan, so depositors' money will get to safeguard this thing after 2008 crisis especially. They came with the concept of CRR SLR, right? First of all, easy way to remember the term cash reserve ratio. It is something cash reserve means extra money being reserved ratio. Now, one pneumatic over here to learn reserve is something related to Reserve Bank of India, right? RBI. So it is the money that banks has to keep with RBI as a reserve, as a security amount. Whenever you take admission in a hostel, in a college, or in a paying as a paying guest, you have to give some principal amount, a small token money as a security amount. This is a security amount, you can say. So just easy way to remember cash, some cash. Reserve means something related to RBI, and it is the cash which is kept as reserve with RBI as a security. Let's see how it works. A depositor gives 100 rupee to a bank. The bank is now unable to. Bank will is it's a mandate basically. Banks are not allowed to give the same amount of money as a loan. Now, out of this 100 rupee, guys, some money banks has to deposit with the RBI, and some money banks has to keep with itself. Now, only out of this 100 rupee, you can say 60 rupee is the amount which bank can give as a loan. Now, taking the same example in 1000 rupee, a depositor is giving 1000 rupee to a bank. Out of this 1000 rupee, 200 rupee SLR, we are going to discuss SLR just in a moment. 200 rupees kept as SLR, 60 rupees kept as CRR. So out of this 1000, banks can now give only 740 rupee as a loan. So still, we are safeguarding at least 250 rupee of the depositors, right? It's a very important concept. One more concept I would like to give you over here, guys. It is it is a coincidence. It is an act of destiny that all the citizens of the country doesn't go to bank at the same time to withdraw their money. Means all the depositors of the country, they never ever go to bank at the same time to withdraw their deposits. If this thing happens, whatsoever the situation is, entire banking system of the country can collapse, completely collapse. Because it's never ever that whatsoever money is being deposited in the bank, that bank is keeping that money with themselves. Banks, our money is always invested somewhere else, because banks are making money out of our money only. It is just like a mutual fund, guys. It is just a asset management company. So banks try to give more and more loans. Bank try to invest our money in stock, in gold, sometimes in real estate as well, in bonds as well. Banks have their own asset management, you know, asset managers who are managing these depositors' money and trying to make more returns to make profits to the bank. And then they return the money to the depositors. Depositors is anyhow getting 2.5% return, guys. But bank tends to make more returns from this money, means more than at least 2.5%. It could be 10%, 20, 20, 150, how much, it could be. So the main motive, bank is a corporate entity, guys. They are not for charity. They are there to make profits. So it is one of the case. Banks' motivation is to give more and more loans so that they earn more money. To use this depositors' money, they can invest this money in various equity stock market companies as well, and that to sometimes risky companies as well, so that they earn more profits faster. So it is a thing that all the depositors will never withdraw money at the same time, and that is the only blessing banking system has. But in 2008, especially in America, what happened that it was a panic situation throughout. Depositors panicked. They started asking for the deposit their own money, and the banking money was somewhere else as a loan. And they had issued, bonds as well against those loans, MBRs. So this is something collapsed the entire system. So that is why government tries their best to avoid such kind of panic situation and not to create such kind of panic situation. It's very very important because such kind of panic will anyhow affect the entire banking system, right? Now, last is SLR, statutory liquidity ratio. Statutory warnings are written in cigarette packets, means it is injurious for health. So it is again a mandate from RBI that, and liquidity means anytime available, means cash is a liquid asset. So it is the minimum amount that a bank has to keep with themselves to serve the clients, depositors basically. I deposit my money 100 rupee to a bank, right? As I told you, it is the only blessings banking system has that I will never ask my 100 rupee completely. I may require 40 rupee out of that or 50 rupee. So bank is anyhow competent enough to pay my 50 rupee at any point of time. But if not only me, if all the depositors start asking for their entire money, it will be very difficult for the banks. So to manage day-to-day requirements, cash requirements, so SLR ratio was given. So bank has to keep some kind of cash with themselves so that they can return if depositors ask their money back. Some amount of money, at least some amount of, and some amount of money is safe with the bank. Depositors' money. Bank are not allowed to give the entire, means depositors' money can't be given 100% to the as a loan. So there is some takeaway, which bank has to keep with themselves, and RBI they have to deposit with the RBI basically, right? But in SLR, RBI had mandated that they can keep cash, they can keep government security, as government security is also considered, as I told you, as an asset, and government securities are also one of the most liquid form of cash, liquid form of asset, just equivalent to cash basically. So yes, they can keep it in the form of government security, and some of the SLR can be converted as a gold. Why this thing is given? This is again a very important question. The answer to this question is, guys, banking systems are profitable entities. They want to earn profits. And if government, doesn't allow them to earn profits, there will be no motivation for the banks to function in India, right? And India needs banking system right now. We are a growing nation, right? So that is why, keeping government securities, banks will earn some extra money, some extra interest. Keeping gold as well, bank will again, get some kind of capital gain as well. Sorry, the gain, which asset gain, which they are going to get on the gold. And gold prices will keep rising, right? So it is again, SLR is a motivation for the banks. Anyhow, banks don't like this SLR and CRR. They hate this because they would like to give the entire money as a, so that they can earn more money. Because for a bank, Depositors' money are considered as liability because they have to pay it back after some time, and loans are considered are assets for a bank because they are going to earn money from that. Banks earn money from loans, huh? So it is a motivation for the bank to give more and more loan because they are going to make profits out of loans. So more loans, better the bank is. More depositors, less loan, the bank is not. So that is why banks' motivation is to give more and more loans. So if something is stopping them to give loans, they will hate that. That's why banks hate SLR and CRRs. To again make this thing easy for the bank, right, for the banking system, they had, RBI had given some kind of relaxation that instead of cash, they can give government security. So at least they will be earning some money from the government security and some from the gold as well, right? So this is how the entire system works. So government securities can act as an asset in SLR. So they don't even have to keep the cash; they can keep it as a government security. I hope this is clear to everyone. Now, one question I would like to ask from all of you: why India converted post offices into banks? What was the requirement? Means why not railways? Why not some another organization? Why only post offices were converted into banks? If you are not aware, guys, you can do banking transactions and financial transactions in post office. Post office also has many financial instruments, FDs, RDs. They also have deposit. You deposit your money over there. And now again, now they're giving electronic services as well, online banking, ATMs, and all these things. Why it was done? Yes. After this one last question, and we are good to go. So right answer would be, guys, when we got independent, India was not having a good banking system, and private banks were not motivated enough because first they were not depositors, very less depositors. India was a poor nation at that point of time. People were not having trust on the banking system. People used to think they will run away taking your money. Trust me, in those days, people had no interest, no trust on the banking system. So what government decided, and government needed penetration, right? For a good economy, we need to have good banking system, and government needed penetration in the village level as well. So there were only two departments which were good. One was railway, another was post office. Because Britishers had really made these departments, and this department had penetrated in the village level as well. You'll find a post office at the mountain top as well, right? Railways were overoccupied with the jobs they are having, so it was left with post office. So post office was made as a banking system. It was incorporated in the streamline of the banking system. And thus, since then, even till today, people use post office. And you will find a post office as remotest area as well, where the normal banking system have not even penetrated yet. So that was why we converted post offices. And now there are multiple private banks as well working in India. But you can see, private banks are not willing to work and not willing to penetrate in the villages, right? So there are multiple scenario over here. Now, this is the most important topic, most important question. I told you in the beginning of the class that interest rates are increased, interest rates are decreased, right? Now, which interest rates are they? What they repo rates, reverse repo, CRR, SLR? What is happening to which interest rate? If repo is increasing, what will happen to reverse repo? If reverse repo is increasing, what will happen to repo? Because they both seems to be contradictory and opposite. So what interest rates we were talking about at that point of time? Again, a very interesting question and a very simple question. And being investment banking students, it is very important for you to understand this thing. Which interest rates the central banks are talking about, and what is the outcome? What exactly happens when the interest rates are either increased or decreased? And which interest rates are these in the economy? Yes, guys, take your time, think, and let me know. Okay. So, guys, there are two types of monetary policies, first of all. First is dovish, expansionary, accommodative. As the English term itself suggests you, it is something is expanding. So it means when the interest rates are decreased, money supply is increased and inflation also rises. But it leads to the increase of the growth rate. That is why it is called as expansionary. When a country wants to expand, wants to bring more jobs, wants to grow more industries, more factories, more production, then interest rates will be decreased. And being investment bankers, whenever interest rate goes down, it's the best time for you to invest because now the market will open up and slowly more companies will come in, more money will start coming in. There are chances that stock market will start going up. So whenever in monetary policy the rates are increased, it will increase the money supply because growth will increase, and with growth jobs will come in, new companies, new factories, new startups. Yes, outcome will be on inflation as well. Now the question is which interest rates? So answer would be all the interest rates of the economy, all the interest rates. It will be CRR will also, SLR will also be, bank rates, reverse repo, repo rate, all the interest rates will if we are increasing it, all the interest rates will increase. And if we are decreasing it, all the interest rates will decrease. So when we are expanding something, so, the central bank decreases all the interest rates. And how it is linked with USA and how USA is linked with the entire world, guys, the first step, 2 or 3 months before only, you know, USA and the federal bank will either increase or decrease their interest rates. The repercussions would be after 2 or 3 months, the entire world will start following the same step. So, being investment bankers, you need to keep an eye on the USA stock market and USA's Fed and USA's monetary policy. Something happens in USA is replicated throughout the world in a matter of time, just after 1 or 2 months. So if USA decreases the interest rates, 100% guarantee same is going to happen with us. So if something is happening in that economy, that is going to be replicated. In the upcoming classes, I'm going to teach you how crude oil prices also affects the stock markets. And something happens in USA, how it is replicated in Indian stock market as well. These all things are very much relatable to each other. So we need to keep an eye on that. So if USA's monetary policy, the interest rates are there is a cut on the interest rates, same will happen in India. It means Indian companies will grow, inflation will come in, but stock market will also go up, and people will invest more money in the stock market, right? So what interest rates will be decreased over here? All the interest rates will go low. CRR will go less, and with the interest rates going less, money supply will increase. Now let's see practically. Let's see how it works. Let's see conceptually. I told you all the interest rates. All the interest rate means interest rates with FDs, RDs, bank saving account, loan interest rates. All these interest rates of the economy will go down. And what will exactly happen if the interest rates are going down? Let's see what will happen. Starting from the practical ones. If the saving interest rate, bank saving interest rate for the depositors from 2.5% becomes less to 2%, you will not feel motivated to keep your money in the savings account. You will withdraw the money. Money supply will increase and you will do something else with that. Similarly, if FDRD rates from 6% becomes 5% less, you will not feel motivated to invest in FDs and RDs. You will again withdraw the money and do something else with that money, right? Similarly, if the loan rates goes low, so new companies will come and take more and more loans and start new businesses. So more loan will increase the money supply towards myself, means economy. People will take more loans, new businesses, right? So don't you think, guys, in decreasing just one rate is decreasing all the rates in the economy, and all these rates are affecting increase in the money supply. And with increase in the money supply, new industries are coming in, new startups, new jobs. There is a huge demand in the market. So this is how these rates are also decreased. Now coming to what will happen to CRR, SLR, and repo and reverse repo. Guys, I told you banks hate CRR and SLR. They are affecting their profits. So if CRR rate and SLR rate both are less, bank will be most happiest for people, bankers. So bank will now don't have to. Earlier, for example, they had to keep out of 100 rupees, they had to keep 20 rupees as CRR and SLR, just for an example. Now, if they have to keep only 10 rupees, now again 10 rupees left free for them. They can give it as loan, they can invest somewhere else, they can earn more money from that. So banking people become more happy when SLR and CRR decreased and they give more loan in the economy. And again, with more loans, people will withdraw more money from the banks and again, money supply will increase. So again, all these things will increase the money supply. Now, repo rate and reverse repo rate, how it works. Guys, if the repo rate is decreased, right, the bank will not keep money with RBI anymore because they're not getting returns from RBI. So they will withdraw all the money from RBI and they will give it somewhere else. They will park it somewhere else. So again, RBI is this time giving money, infusing money in the economy. So banks will have more money. Banks will give more money to the people as loan. Lo, tum be low. Everyone keep money, take loans, and so everyone is happy. Everyone is taking loan. Everyone is withdrawing money, buying stuff like that. So it makes economy quite liberal, more liquidity, and that money will end up in the stock market. That money will end up in equity, and that money people are going to buy more stuff. More jobs will be created. So this is how, and this is why it is called as dovish and expansionary policy. When interest rates are decreased, and with decreasing interest rate, there is only one drawback: that inflation starts rising. I told you it is the only dilemma all the governments of the world face. That once, or it becomes very difficult to maintain that thin line, equilibrium between growth, money supply, jobs, and inflation rate, because everything is so much related to each other. And yes, it is a tough decision to take, guys. It is a tough decision. Means in India, not in India, policy making is a difficult thing to do. Means if I am making 100 people happy with my policy, there will be 20, 30 people who will be unhappy with my policy. It's very difficult to make all the people happy at the same time. It is policy making is, you can say, shades of gray. What does it mean? Shades of gray, that you have to choose between less bad and more bad. It's nothing white and black, good and bad. It's never like that. In politics as well, in decision making as well. Your decisions, a time will come, guys, in leadership positions when your decisions will not be good and bad. It will be less bad, more bad. You can't make everyone happy. Some people will not be happy, some people will be happy. It's just the shades of gray. Less bad, more good, less good. It's never black and white. Life is not like that. And policy drafting is definitely not like that. Means if you are creating a dam, if you are building a dam, if you are building, you know, a dam for electricity, it's a good thing. It's giving electricity to the people, right? But at the same time, it is degrading the environment as well. At the same time, it is displacing so many people around. So one side you are creating electricity for 1,000 people, 1,000 households. At the same time, you are devastating, you know, nature. You are killing some animals. You are cutting some trees. You are displacing 100 to 100 families. So guys, one side wrong things will be done, another side something good will be happening, both at the same time. So you can't make both the things meet. Same happens with highways. So growth comes with a cost, right? Cost of inflation and cost of negligence towards the poverty, to the poor people. And this is what capitalism is. Capitalism is ruthless, guys. There are no emotions. It's just the profit that matters, right? So this is something we are going to discuss in the next class as well. That capitalism, socialism, communism, how they're different, and why India chose to be a mixed economy, why not capitalist economy. But the thing is that all the decisions are difficult in terms of investment banking as well, right? You will never find a company in investment banking which will be good throughout. Means fundamentally good, technically good, all the things are good. There will be some companies, there will be, again, you have to choose amongst the shades of gray. Good, less good, more good, less bad, more bad. Some companies will be good, some companies will be lesser good, some company will be some more good. You have to choose amongst that only, right? It's never white and black, right? So hawkish policy, contractionary policy, it means when government wants to suck the money back and government wants to inflation go down, basically, right? It is directly affecting the inflation, right? So when the rates are increased, guys, whenever rates are increased, it is always advisable that now the new startups, new factories are going to cut down. Government don't want new factories for some time. Government don't want higher employment. Government wants to cut it down. Government wants your money to be deposited back in the bank. Government don't want you to have money. Government wants no, governments want to cut down the demand again because government don't want you to buy stuff. So government that's why increases all the interest rates. Government will increase the interest rates of the bank depositors. So now from 2%, if you're getting 3% interest rate in the deposit saving bank account, you will keep your money back to the bank. You will not keep your money with yourself. Same from FD and RD. From in FD, if the interest rate from 5% increases to 7%, you will again invest money back to the FD. Again PPF. And if all the interest rates are increased back to back, savings account rate, PPF rates, and all these rates, so you will keep your money back to the bank. And now you people will not have the money, so you can't buy stuff. So if you're not buying the stuff, demands will go low. If there are no demands, guys, the factories will cut down their labor, cut down their production. So many of people may lose the job as well at that point of time. And in India, so let's complete this thing first, and then I'll let you know. Loan interest rate will also go high. So if earlier I was getting loan at the 8% interest rate and 10% interest rate, now if I'm getting the same loan at 14% and 16%. So being a businessman, I will wait for something. I will not take any loan. Why to pay extra money? So again, this will drop, initiation or the beginning of the new companies or starting of the new companies. The new companies will not be started. Similarly, I told you in hawkish and tight contractionary policy, it's all the interest rates that will go up. All the interest rates of the economy will go up. And since you will not have the money to invest, stock market will also get a bit low. Money will start, going out of the stock market. So this is how the entire things are relatable in all the investment tools are linked with each other. Monetary policy can affect the entire economy. It can buzz the entire economy, guys. It is the most important thing for a country to have a good monetary policy and a fiscal policy. Now, if you ask me, how much efficient this policy is. So if the countries like Europe, America, so in European countries, American countries, it is quite efficient. You can say 60 to 70 to 80% efficient, so sometimes 90%. In India, efficiency is around 60 to 75, 70%. Why? First of all, in India, major population is working in uh, what sector that is in unorganized sector. So sorry, where billings are not taking place, and government is not having the right information, right knowledge of the things. Documentation is not happening. So policy making is only done in a good manner when you have the data. When data is not available, it's very difficult to do. Firstly, secondly, guys, after how many years census takes place? Human census, counting of human beings and all people employed and all these things. After 10 years, it's 2024 is going to end. Still, it's not done. It is also very important for policy making. So data is very important. So in India, it is we not have exact data actually. Now, slowly and steadily, things are getting computerized. Digitalization is coming in, so things are increasing. Basically, GSTs have also brought many good reforms. We are moving in a efficient way, but till today, it is around 60 to 70% efficient. So inflation, yes, we can regulate inflation, but not exactly. But yes, in America, it is quite efficient because everything is so streamlined over there. Firstly, secondly, America demand is a big issue. Population is less. In India, demand is never an issue. We have 150, 160 crore people. So demand is never an issue. Even if you sell anything, you can make a lot of money over here, right? So this was about monetary policy. So some extra topics, that difference between IMF and World Bank we already did in the previous session, in the previous video. Please, you can refer to that. Banks, all the banks are entities. They need money, and from where they can take money as a loan, they can take money from RBI, repos and reverse repos. It could be intra-bank as well. Intra-bank means SBI can take from PNB, PNB can from Yes Bank. So banks can take loan from each other as well. It is called as call money, notice money, and term money, depending on the number of days, short-term loans. And banks can take loan from the corporates as well. Corporates means big companies like Reliance, Adani, all these things. So they can take loans from there. So now, in the bond market, we are going to discuss this thing as well. Treasury bills, commercial bills, commercial papers, commercial deposits. So we are going to discuss these things as well in that topic. So I hope all the topics are clear to you. If you face any doubt, feel free to connect any point of time. And thank you so much, guys. Have a great day.